All right, everybody. Here's a quick overview, just a high level on what an earnings trade is and how you set it up. So I'm going to look at Atlassian. Tomorrow, Atlassian has earnings coming up. So I'll give you a quick walkthrough at a high level on what does an earnings trade mean, and how you would set it up. So I'll walk this through and go ahead. It's okay. I'll walk this through in Tastyworks platform. So right now, like I said, the stock is at 235, right? So first of all, an earnings trade, what it is it's a trade that you put up right before earnings comes out. Earnings company comes out with earnings. So tomorrow, Atlassian comes out with their quarterly earnings after the market. So this is a trade that one would put it up, one would start anytime tomorrow during the day, and then they would be out of the trade the day after tomorrow, right after the market opens, you'd get out of the trade. So that's what an earnings trade is. It's just you're in for just for the earnings event, that binary event. And why specifically that? It's because there is high expectation that something's going to happen after the earnings announcement. And let's say the stock reports really earnings that are over the expected earnings, then the stock may go up. Or if they report earnings that are below the expected earnings, then the stock may go down. But in reality, it doesn't really happen that way. So even when the earnings beat expectations, it may still go down. Even when the earnings don't meet the expectations, it may still go up. So you never know. But either way, people like to speculate, and they do make these earnings trades. So here's how it would work. So team is the stock, Atlassian. So if you think that after the earnings tomorrow, the stock will go up, there's a few ways you could set it up. You could buy the stock, and right after that, on Friday, you would basically sell all the stock that you bought, and then you just made money, right? So that's one way you do it. If you think the stock would go down, you could sell the stock, you could short it, and then you buy it back the next day. So that's another way you do it. But you can also use calls and puts. So that's what I'm going to walk you through. So here's the chart right now. It's at 235. So if you wanted to be long on it, which means you think that the stock's going to go up, you could also buy a call option that's above the stock price. So instead of buying, for example, 100 shares of Atlassian, which is at 235, it would cost you $23,500. So instead of buying that, you could buy an out of the money call options. For example, you could buy, if you thought that it would go up from 235 to 240 or above, you could buy the $240 call option, which currently is trading for $8, between 830 and 850. So you could buy it for, let's say, 880, right? You bought that, and I can go to the analysis page here. You can see. So what this is showing you is if the stock price is anywhere above 240, which is the call option you bought, right? If it's anywhere above that, you make money. So the green area is where you make money. So if the stock goes anywhere beyond the 240 strike, you'd make money. Anywhere below that, you'd lose just the 880 that you paid for it, right? So you paid 880 to buy this option. So if the stock stays below 240, it just doesn't go up above that, then you lose the $880. So that's one way to do it. The other way is if you were bearish on it, right? So let's go back here. I'm going to take this out, this leg. So let's say you think that the stock's going to go down after earnings. So you could short the stock. So you could essentially sell 100 shares of Atlassian, which would again cost you about $23,500, because you'd have to pay them what the collateral for the stock price, and then you buy it back if it goes down. But the other way you could do is you could buy the out of the money put option. So in this case, let's say you think that the stock is going to go down below 230. So you could buy the 230 put option. So you could buy that for 770. And then let me go back to the analysis page. So if the stock went down below 230, you'd start making money. Of course, the more it goes down, the more money you'd make. But if it stays above 230, you lose the 770 that you paid for the put option. So that's how you would get bearish on this stock right before earnings, right? And then you'd sell it off right after that, the next day. But I also want to show you another option. So I want you guys to think about the other side of the trade. So here's where things get kind of interesting. So when you were bullish, when you thought that this stock was going to go up above 240, you bought the call option, right? But think about the other side of the trade. Somebody had to sell you this call option that you bought. So whoever sold you this option for 880, right? What they are thinking is they're thinking the stock may stay the same. The stock probably will go down, but it may also go up, but it just won't go up beyond 240 is what they are thinking. In fact, they even have more room than that because you paid 880. Their profit potential is all the way until uh, well, they'll start losing as the stock goes beyond 240, but if it goes $248.80, if it goes beyond that, then they won't make any money, right? But until then, they could make some money. So what the other guy would do is instead of you buying this, the other guy is selling, right? So let me show you how that looks. They would short it. Actually, let me take it to 250 so it's a little more clear. So let's say he sold you were bullish and you bought the 250 call option, but the other guy sold you the 250 call option for $480, right? So let's look at the other guy's curve. So for him, this is how his profit potential would look. For that guy, the stock is right now at 235. If the stock stays here, he makes he pockets the money that he sold you this option for. So he sold it to you for $480, so he gets to keep it if the stock stays at this price. If the stock goes anywhere below, he gets to keep that. If the stock goes up but still stays below 250, he still profits the $480. So that's another way you can be not quite bullish. You're just not as bullish. So you're buying yourself some room here. You're saying that the stock may go down, it may stay the same, it may even go up, but as long as it stays below 250, the other guy would make money. Of course, if it goes beyond that, he will start losing money. So let's go back to the table here and let's look at the profit and loss analysis. So like you see here, if it goes, so the max profit for this guy is $480 and the probability of profit is 76%, but the max loss is infinity because if the stock could theoretically go up to infinity. Of course, it's not going to do that, but if it did, this guy, whoever sold you this, he has unlimited loss potential. So that's for the guy that is selling you the options. So for an option seller, the loss potential could be infinity. However, they can mitigate the loss also by buying an out of the money call option along with this option. So let's say they bought this. Let me actually flip it. All right. So he sold you 480, but he sold you the 250 call option and he bought the 260 call option, and the whole trade will cost him 200 and well, it'll actually net him $220. So that's his max profit. His max loss is if the stock goes beyond 260, then he will lose $780 in this case. So that way he could minimize his loss. As you can see here, the loss kind of it flattens out after this 260 strike price where he sold the call option. So anyway, that's another way to do it. That's another way to be bearish and still, have some room for profit. You could also, if you are bullish, the other way to do it is you could also sell a put option. So right there, the stock's at 225. You could sell the 225 put option, and you have a $560 of max profit. Of course, max loss is if the stock goes all the way to zero, you lose $21,940. So that, or again, you can minimize your loss potential by buying an out of the money put along with this. So now your max loss is just 340, and then your max profit is 160 here, $160. So that's how you would set up these trades. You could either buy the stock if you're bullish, or you could buy an out of the money call, or you could sell an out of the money put. So that's three ways to be bullish. If you're bearish, you could short the stock, you could buy an out of the money put, you could buy an out of the money put, or you could sell an out of the money call. All three are bullish scenario or bearish scenarios. However, you have some room, some wiggle room for the stock to move around. It just has to stay below this 250 strike right here, and you'll still make some money. So that's a high level overview of how earnings trades are set up. Today I had a few earnings trades. I had earnings trades in Twitter. Netflix had an earnings trade the other day. Netflix actually went down. I was negative on it. Microsoft, I had an earnings trade, and I'll get into when would you actually get bullish and bearish. That's out of the scope for this video, but I'll probably talk about that in another video. So hopefully that makes it clear, just at a high level, how you would set up earnings trades and few options to set up earnings trades. All right, with that, I'm done. Talk to you guys later.